The investment performance of Sovereign Wealth Fund GIC in 2023 was at its weakest in 4 years. The annualised 20-year real rate of return fell to 3.9% from 4.6% in the previous financial year. And GIC says the dip is due to a more cautious stance in recent years. A high-performing financial year was also left out from the rolling average. Nasyrah Rohim reports.
Increased enthusiasm around generative AI boosted GIC's returns in the tech sector. The firm also had more capital to invest in emerging areas, like Indian agri-tech firm Vigro. GIC says it's taking a more granular investment approach, as uncertainty has intensified to what it calls a profound level. For instance, supply chain disruptions could increase the risk of inflation staying higher for longer, along with lower growth.
We are not looking at how it had been in the past, let's say, 5 decades or so, where perhaps you have more predictable economic cycle and business cycle. You have just a lot more external risks. We are talking about the pandemic. We are talking about more war that's happened. We are talking about technological changes which have impacted business a lot more significantly nowadays than prior cycle.
To continue generating long-term returns, GIC has set up an investment program for green assets. It'll back companies like Climeworks, which has invented a way to remove and store carbon dioxide. GIC CEO Lim Chow Kiat says such companies require long-term capital to grow, yet lack the track record to attract infrastructure funding. It's looking to bridge a funding gap for climate technologies, a move that one analyst says will take time before returns pick up.
I think the biggest problem in the green sector right now is we are still getting around the standardization of data, the definitions of what we will use and what is required for disclosure. And I think once we get to those stages, maybe in the next 2 to 4 years, then the investment returns will be much higher in the green sector.
GIC has also not ruled out investing in firms listed on the Singapore Exchange, adding that it is open to doing so if it deems such firms have global businesses.
GIC contributes to the single largest source of government revenue, the net investment returns contribution, along with the Monetary Authority of Singapore and Temasek Holdings. Let's take a closer look at the 3 entities. Now, GIC is a professional fund management company that invests part of the reserves in a globally diversified portfolio spread across various asset classes. Its mandate is to achieve good long-term returns above global inflation. Temasek Holdings is an investment company wholly owned by the government. It is a pure equity investor that aims to deliver sustainable long-term returns. More than a quarter of Temasek's portfolio is invested in Singapore. Then there is the Monetary Authority of Singapore, the country's central bank. It manages the official foreign reserves and is the most conservative of the 3 entities, investing mainly in liquid financial market instruments. Now, the government is allowed to spend half of the long-term expected real returns from the 3 entities. The other half comes from dividends, interest and income derived from investing past reserves. This split is why one analyst says Singapore's budget will only be impacted marginally if the 3 entities perform below expectations.
The main thing is actually the expectation over the long term. So even if the current year is affected, I don't think some other, the other 50%, which is the expected, will be actually seeing a huge decline. So I wouldn't be too much worried about the impact on the budget inclusion for next year or even beyond.